Hi, I'm Jimmy. In this video, we're looking at how overvalued the stock market really is today using the stock market's history to come up with a reasonable level. And if the stock market does crash, again, how far will it fall or how far should it fall? Now, we're using the data behind this chart to help give us some fantastic insight as to how the stock market really moves. And ultimately, this will guide us as to where the stock market should be today. Now, we could do the same thing for individual companies to help us identify better investment opportunities. We'll see how all this works in a second. Now, I know that this looks like a lot, but don't worry, we're going to break it down. It's actually quite simple once we walk through the whole process, and I'll show you how powerful this really can be. Okay, so let's jump right in. And let me just lay the groundwork real quick, just so we're all on the same page. So this is a chart of the S&P 500 going back the past 10 years, or the price of the S&P 500 over the past 10 years. I know, it's been on one heck of a run. Now, granted, 10 years ago, the stock market was coming off of near the lows coming out of the financial crisis. So take that for what it's worth. Okay, so right now, the S&P 500 is trading at almost 30x from a price to earnings perspective. Now, just so we're on the same page, to keep this as simple as possible, the way we calculate price to earnings is we simply take the current price of the stock, or in this case, of the S&P 500 index, and then we divide that by the earnings per share from the past 12 months. This is the very popular PE ratio that I'm sure nearly all of us have heard about. Now, at the time that I'm shooting this video, well, the S&P 500 is right around 43.50. So we take that as the price and we divide that by the earnings per share of the companies within the S&P 500. Right now, that happens to be about $146 per share. Those numbers are as of last week. And the numbers can be a bit tricky to find. They're much simpler for a company. For an index, it's a bit tricky. You gotta Google it, look up. A lot of times the website might have it. Companies, it's much easier because it's simply the earnings per share for that company. But either way, this is how we get the 30x. And ideally, we want to pay as low as possible, the multiple to be as low as possible. So right now, if we were to buy, let's say, an S&P 500 ETF, well, we're paying $30 for every $1 of earnings. That's what 30x means. So our question is that a good price to pay, or is that too high, or way too high? Well, I calculated the average of the S&P 500 over the past 10 years. And during this entire time period, well, the average PE multiple is about 19x. So we would pay 19 times profit on average. Right now, we have to pay 30x. So essentially, we're paying $11 more than on average per $1 of earnings. Now, looking at this chart, well, clearly there's been a few opportunities where we could have jumped into the stock market when it was below the average. The problem is that I've realized that back during these time periods back here, well, earnings per share was different. So 19x, based on the earnings per share, let's say 5 years ago, would have been different than they are today. So the level, the price, the fair price of the S&P 500 would have been lower or higher depending on where earnings per share were. So really what we need to know is what the profits were back then. We then multiply those earnings per share, the profit per share, same thing, by 19x. We multiply that by 19 and we end up with what the fair value of the stock market should have been back then. So this orange line ends up being where the stock market should have been trading if it had consistently been trading at 19x over the past 10 years. This is what the price of the stock market would have looked like. And just so we all know how to read this chart, let's take a single point in time just as an example so we can illustrate how this works. So let's take this point in time right here and say, okay, based on the earnings per share, if you take the 12 months of earnings per share before that, and then we multiply that by 19 to represent our 19x, which is the long-term average, well, the stock market should have been trading at around 2100. Instead, at that time, the stock market was trading at about 1900. So if we believe that 19x is the right multiple for the fair value of the stock market, well then at that time, the stock market was undervalued. Now, basically that's all we're looking for. If the orange line is above the blue line, the stock market's undervalued. If the orange line is below the blue line, the stock market is overvalued, and where they intersect is the fair value in theory of the stock market. So if we believe that 19x is a reasonable level to use, well then when the blue line is below the orange line, well this is a great time to jump into an investment, something like a S&P 500 ETF, something like VOO or SPY. Both of those are pretty good. Of course, back here, when the gap is bigger, the wider the gap, the more undervalued the stock market actually is, because we would have bought that way below the 19x. Now, with the most recent time period, well, we can see that there's a huge gap between 19x and 30x. So, according to the stock market's own history, well, the stock market should be closer to 2,800 right now, which is obviously much lower than the current level. Okay, now, a very logical question for us to ask is, what if the stock market shouldn't be trading at 19x? What if it should, in fact, be trading higher? After all, interest rates are super low right now. So in theory, it's possible that super low interest rates leads the money that would typically be in higher paying bonds to the stock market chasing yield. So the stock market, in theory, should be higher. Okay, so what if we said it shouldn't be at 19x, we'll go up 4x and we'll say it should be trading at 23x? Well, using the very same principle as before, we can see that with the 23x, well, this pinkish line, well, we can see that now there are many, many years where it looks like the stock market was undervalued, and obviously the gaps changed. The gap early on is much bigger at 23x than it was at 19x, implying that the stock market was even more undervalued if we believe that 23x would have been a fair number to use. Okay, now what if we say 23x isn't high enough? What if it should be, let's go 4x more and say it's 27x. Well, at 27x, well, now it looks like that all of these years before the most recent time period was undervalued. And clearly that's just ridiculous. And common sense also says that it shouldn't be trading at 27x. Okay, now we might say moving higher with the multiple isn't what we should do. Perhaps we should move lower with it, because perhaps we want to buy it below the long-term average. And by the way, I mentioned that over the past 10 years, the average PE multiple was about 19x. And I was curious, is that because we are in fact, in that average, we are in fact including the very high current PE ratio? So what I did is I went back the past 20 years and averaged out the PE multiple then. And once again, over the past 20 years, the average PE multiple came in again at about 19x. Now, of course, I'm rounding to the nearest whole number. Over the past 10 years, the number came in slightly above 19x. I want to say it was like 19.1, 19.13, something like that. But then over the past 20 years, it was slightly below 19. So it was like 18.91 or some such number. But either way, we don't need to get that specific. We can just simply say at 19x, call that the average, and then we want to add a little wiggle room. We have to recognize that there is a little wiggle room in there. And then if you're curious, I actually went back 30 years, and over the 30-year period, well, the average actually jumped closer to 20x. I think it was a hair short of 20x. So 19x, in my mind, seems like a very reasonable number to use. It's been that way for about 30 years, give or take, or about 20 years, give or take. Either way, how do the numbers look if we were to take a lower PE multiple? So let's take the number 15x. Instead of 19x, we're going to use 15x. So we went up by multiples of 4. We'll go down by a multiple of 4. And that's what this green line is. And just to clean up the chart a little bit, let's get rid of everything else except for the S&P 500 and the green line. And the green line represents what the stock market should be trading at if we believe 15x was a fair multiple. Well, one thing that I find interesting about here is that we wouldn't really invest. There was only 2 real buying opportunities in the past 10 years. Early on, coming off the lows from the Great Recession, 2011, 2012 area, we could have bought back then. But there was another quick opportunity. We had a hot second in 2020 when the market really pulled back that got it to about 15x. And I think this evidence alone sort of proves the fact that 15x is simply too low of a number. In my mind, 19x makes the most sense. So now to answer the question, if the stock market were to crash, how far should it fall? Well, if we believe that 19x is a logical number to go with, and I think it's a good number for us to stick with, well, we have to assume that at some point the stock market, the price will revert to the mean. And if that should happen, well, the stock market would need to fall by about 35, 36% to get us there. This would bring us back to the long-term average. And as Warren Buffett's mentor once said, Benjamin Graham, well, he said that in the short run, the market is a voting machine, but in the long run, it's a weighing machine, implying that everything at some point in the long run comes back to the mean. So we don't know when the stock market is going to correct itself. But if we have any long-term experience in the stock market or have studied the history of the stock market at all, well, we know it will, in fact, correct itself. Now, we can apply this very same concept to a company and use the price to earnings or price to sales or EV to EBITDA. We could do any one of those methods and create the very same band-like chart that allows us to look at that. If I was thinking about doing that maybe for industries or something like that, if that's something you'd be interested in seeing, please let me know in the comments below. Now, of course, the ratio we choose should be industry specific. We might use price to book ratio if we're looking at investment banks or something along those lines. So make sure we apply the correct ratio to it. Now, of course, the key is that we truly understand the company that we're looking at, or the company we're looking to invest in, or the company we've already invested in. Sure, this method can help us identify and buy companies at a reasonable price. But if it's a garbage company because we haven't researched it, so we don't know, well, maybe it should be trading at a super low multiple. Maybe it's got a high growth rate, it should be trading at a higher multiple. But either way, that's information we want to know. We want to be able to research the company to be able to determine what the correct level is or what the correct multiple is. Now, I did a video not too long ago called How to Pick Better Stocks. And basically in that video, well, I went through how to truly identify what moves the company, what moves the stock price higher or lower. And this could be super powerful information to know when it comes to picking stocks that are really undervalued. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.